Welcome to Tony Martignetti Nonprofit Radio coverage of Fundraising Day 2013. We're at the Marriott Marquis Hotel in Times Square, New York. With me now are Doug White and Greg Muth. Doug is adjunct faculty member at Columbia University, and Greg Muth is a private investor and also adjunct faculty at Columbia University. Columbia University, welcome Lions.
Thank you.
Thank you.
Pleasure. I know the Lions because I live uptown near Baker Field, near the athletic field. Gentlemen, your topic is hedge funds, private equity, leveraged buyouts, unlocking the mystery of Wall Street, financial literacy for fundraisers. Greg, why are these topics important for fundraisers?
Well, mainly because the traditional investment asset classes that endowments have used have basically not performed as well as could be expected, and so alternative classes have come into being, which essentially covers the area of hedge funds, private equity, and so forth and so on.
Do these have relevance for small and mid-sized charities, or is this really only for more sophisticated fundraising shops?
I'll be honest with you that I'm a trustee over several endowments that are as small as $10 million, and these are very, very relevant for endowments of that size and larger.
Okay, so really a minimum $10 million endowment or so? Or?
I wouldn't put a minimum, and essentially it's really driven by what the asset manager will accept. How little will the asset manager accept?
Okay.
So many shops will put a minimum. I only would take participations of at some threshold.
All right, Doug, go ahead. You sound like you wanted to add something?
Well, I was just going to agree with that. I don't think you should have a minimum on that. The idea is diversity, not what kind of asset. And you can find a lot of diversity in the smaller, what is considered today a smaller endowment of $10 million or even less. So I agree with that. But the question is diversity search.
Okay, let's start to search for diversity. Why don't we start with hedge funds? Let's define this, because a lot of people may not even be certain what a hedge fund is. Greg, you want to give a definition?
Sure. A hedge fund essentially is a private pool of money that is run by based on various portfolio theory. It is the most simple of which is what we call a long-short equity fund or a non-directional strategy.
Oh my God! Now, Tony Martignetti Nonprofit Radio has jargon jail. You're going to have to unpack some of this, or keep it simpler from the outset. But right now, you're in jargon jail. Go ahead. So, please, what do these terms mean?
Well, traditional investing by either individuals or small firms would go to an investment advisor and buy and hold something.
Okay.
In today's world, where investments are now beyond the United States, they're all over the world, meaning the assets in which someone can invest and make money, need a bit more sophistication, and the idea of buying and holding a particular asset for a long period of time has proven not to be as lucrative as it could be.
Okay. So that's why the diversity that Doug mentioned.
Diversification is key, so that money can be invested across a series of asset classes, for instance, equity, debt, private buyout funds, hedge funds, so forth and so on.
Okay, equity is stocks, debt is bonds. We got to keep it at a simple level because a lot of people may not be aware of what we're explaining. All right, so a simple definition of a hedge fund.
A private pool of money managed by individuals using both quantitative and qualitative investment theories.
Okay. Doug, are you comfortable talking about how the fundraiser can start to investigate these topics with their prospects and donors?
Well, I think there are two issues here. One is that you have to understand that many of the people who are being asked for money are coming from this world. And so the prospects themselves will have a pretty intimate understanding of many of these things. So the fundraiser, in order to have some credibility when he goes out or she goes out and talks to people, should have some basic understanding of these terms and how they apply to how the endowment is going to be invested. Secondly, though, on the other side of the coin, the other crucial issue is that when a fundraiser goes out to talk to a donor, he or she is able to convey that there is a a sophistication as well as a security at the organization that the money will be safe as time passes and that things will happen as a result of the donation. I think those are the two messages that a fundraiser needs to take from this conversation.
How does a hedge fund become a gift?
Oh, you're talking about that as an asset for a gift?
Well, no, just now. Yeah.
Okay, I'll let Greg answer that question.
A hedge fund becomes a gift essentially as one of the investors in the fund. So for instance, you may have, I'll give you an example, university endowments, a portion of their assets are invested in funds. You can personally make a gift to the university and specify that you want to invest along with the university, which happens to invest in a portfolio of assets. And you can actually enjoy the up or the down of the performance of the university investment company that's running the whole endowment.
Okay. And what level of sophistication does the organization need within the finance office, the CFO?
Well, the beauty of this is you as the gift maker need little sophistication. Clearly, the investment management expertise of the university has to be on par with what is out there.
Okay, so we're involving, let me turn to you, Doug, we're involving the board, the investment committee of the board?
Oh, yes, there's no question about it. In fact, I think that one of the problems that organizations have is that the board is too disengaged in this process. They need to be much more engaged. Now, that isn't to say they have to be as sophisticated as Greg or other investment advisors, but they have to be engaged enough because they are the bottom line. They are the stopgap to the organization's success and fiduciary responsibilities. So the board, in my view, has been so lacking in that. The boards that I've worked with and boards that I'm aware of have been so lacking in that oversight that they have to step up that game incredibly.
Okay. So the gift then, the charitable gift, is a share of the hedge fund?
Yes, it's a participant in the fund, absolutely.
Okay. Let's talk about your next topic, private equity. How does private equity become a charitable gift? Well, wait, what are we talking about private equity first?
Well, private equity is a form of investing where essentially a pool of money is gathered, and they typically make an investment in a company, helping a company either grow a particular idea or help a company that is in distress and, if you will, provide it with management, needed cash, and expertise to take it from, if you will, a distressed situation to back to normal.
And how does this, Greg, become a charitable gift?
Similarly, large nonprofits that have, if you will, endowments, make investments in private equity funds. And so someone as a donor would be participating with their organization in helping this company go from, if you will, distress to, if you will, excellence. Okay, so the scenario would be that the donor is coming to the charity with the opportunity to invest in the company, have an ownership stake in this distressed company. Certainly. A small donor doesn't have access to or know who's looking at the companies that are in need of help. Yet a not-for-profit that has an endowment of size is out there looking all the time because they're looking for a return on the investment of the endowment. Okay. And so you get the benefit, even at your smallest gift, you get the benefit of expertise by your organization who's running your endowment.
Doug, was there something you'd like to add?
I was just going to say that comes with some concern. One of the reasons that these are so attractive is its upside potential, but in the investment world anyway, with something that has a lot of upside potential, it also has a lot of downside potential. And so this is where the board comes in. You were asking about that earlier. There should be policies about how, as you're describing these assets as gift mechanisms, there should be policies about accepting those gifts. Now, I'm not saying that you shouldn't do it, but the point is that there is a level of understanding that needs to be incorporated by the board before they do this, and so therefore there should be policies that guide this.
Doug, much of your research and your writing is around ethics for nonprofits, and you've been on the show before talking about exactly that, ethical challenges. You see some here?
Oh, yes. In fact, in that last book that we talked about a couple of years ago.
Give the name, go ahead.
Of the Nonprofit Challenge.
Okay.
And the issue there was the recession that everybody went into, and this really dovetails with what Greg was talking about just a few minutes ago in our session about how the larger endowments got caught without any liquidity because they overextended themselves into these hedge funds and other alternative assets. That doesn't make the assets bad by definition.
Right.
We want to make that very clear. But by the same token, the organizations found themselves in a position where they couldn't pay their bills. That, to me, is an ethical decision-making process that wasn't well executed.
Doug raises a very important issue.
Yeah, critical.
There's nothing worse than a small donor making a gift going into a, if you will, an investment scheme that turns out to be bad. And it's very disconcerting. And as Doug has mentioned, it's policy issues, and it starts at the top, where investments that have gone bad generally can be rooted back to there was either a no policy or a violation of an existing policy.
Let me give you an example of a violation of an existing policy. We all know the name Bernie Madoff. And not only because he was on the board of an organization and Ezra Merkin was the investment chairman of that same organization was that an issue. That was another kind of an issue. But an organization might have in place a policy that says we won't be investing in more than, let's say, 10% of our endowment with any one advisor.
Right.
That is not a mathematical complication. It's an ethical, to me anyway, it's an ethical decision-making process. But and it doesn't involve understanding the hedge funds or the issues involving risk and return. It involves saying, hold it, we just don't want to be too beholden to one organization or one advisor, and so we're going to have this policy. So now this group had a policy of that 10% and then violated it because the returns were so great, and then they fell apart.
So often I think we see these policies, whether it's around gift acceptance or other policies, Doug, written and put on a shelf.
I did a talk on this in Washington last week, this very issue. They seem to be written and put on a shelf as if you've done it and it's now in stone and it never has to be revisited.
Okay, checked off, that's done.
Exactly. And
now we can move on. Yeah.
This is where I get so frustrated with boards because they have this mindset that there's this check-off process. Policies are living, breathing organisms, and they need to be revisited often, and they certainly need to be adhered to. And when something weird comes up, like saying, oh, I have a share in a hedge fund that I'd like to give you, well, probably that's not going to be in even the best of put-together policies. So it has to be looked at within the context of the organization's ethos as well as its ability to withstand the potential loss. Now, that doesn't, again, say that the organization shouldn't do it, but it needs to pay more attention to it. And the route to that is to have a breathing policy-making decision process at the top.
Yeah, breathing, the operative word, right?
Yes, exactly.
Greg, before we leave private equity, what's one more thing you'd like fundraisers to know about private equity as a charitable gift?
Well, to the point that has been made already, one, what is the policy and how valuable would this gift be to a charity? If you have something as potentially interesting, sophisticated, but you give it to an organization that is less or not prepared, there's very little way to monitor whether it's going to be successful. I mean, it's not like cash. It could be, but it's not like cash.
How do you value it? Just as a question, I don't mean to interrupt your question.
No, please.
But Greg, let's say someone wants to give you a hedge fund. What's the valuation process?
Exactly. Depending upon what is inside, if you will, the components of the fund, meaning stocks, bonds, real estate, tree farm. I mean, basically, valuation is a tricky thing. Clearly, securities, there is a mark-to-market that goes on daily basis by third parties. But one of the private equity big issues was having assets that there's no value for them. For case of real estate, case in point, the value is generally set by the gift maker. This is what I believe it is. But if you don't have the expertise on the other side, you accept it, and
maybe at your own peril.
You accept it at your own peril because, of course, what you want to do is you want to liquidate it because you want the cash for operating purposes. And so you've accepted a gift that you believe to be of a level of value that turns out not to be.
we can be smarter about valuation, I'm sure.
And the acceptance process, because if you go in there saying we're going to accept this hedge fund gift and expect it to be liquidated tomorrow, you're already on the wrong track. So you have to have the understanding that this is more of a long-term asset growth kind of possibility than it is something you're going to turn around in overnight.
Greg, let's leave this. We have about 4 minutes or so left. Your last potential gift, leveraged buyouts.
Yes.
What are we talking about?
A leveraged buyout.
Remember to keep it simple.
A leveraged buyout, again, is a pool of private money that essentially is used to acquire companies, to basically take, if you will, distressed companies, turn them around, make them better. And generally, so there are, if you will, investors, including large endowments, who will want to participate in someone identifying a distressed company.
Yes.
Bring to them management and cash, and convert them from, if you will, a train wreck into something positive. And the way, at the end of the day, there is a cash event, meaning the fund sells the company for cash.
Okay.
And so that's how the endowment makes money.
And is that how it's distinguished from the private equity? That there's a sale? How do we distinguish those two?
The biggest distinction is in a leveraged buyout fund, there's a significant larger use of debt. So there's leverage, just as the name suggests. So a company that basically is worth, $1 million, there might be only $10 million of real equity, and 90 is borrowed.
Ah, okay. So it's that. So it's the company that. It's the company's debt.
Correct.
That's what leveraging refers to.
Correct.
Okay. Heavily debted companies. And is that what makes them distressed?
They were distressed, generally speaking, for management or operational reasons. They've been identified by, if you will, a fund that sees them in a distressed position. They make an offer to buy them. They borrow the vast majority of the money to buy them, and they put a lower level of their own equity in it. Together, they have a pool of money and buy the company.
Okay, and the charity can be involved as a participant in this buying fund.
Absolutely, and the returns on these things can be very, very high.
Okay, go ahead, Doug. Yes,
it can be, but would it be too unfair, Greg, to also extrapolate that to say that the charity not only is participating in this potentially high-value gift, but also potentially investing in the laying off of many workers?
There's no doubt that there are circumstances involved in turning a company around, and in many cases that has resulted in changes in management, reductions in expenses, headcount, and so forth.
And what I'm trying to say by that isn't to say, aha,
Doug was the moderator of the program. If you haven't picked that up yet, so
I'm
please.
so sorry.
Yeah, no, absolutely, don't apologize.
But I just wanted to point out, I don't mean to say that that's an automatic negative thing, but it is a question that a board should ask itself. Period.
Can we be involved in that?
That's right.
Ethically.
That's right. And that doesn't mean you can't be, but there should be a conversation about it with ethical decision-making guidelines being adhered to.
That's fair.
Okay. Doug is keeping the organization's feet to the fire, and
we need Doug's
for sure. And
we need Greg's more than we need me.
But to that end, you have a book coming out about obligations and ethics in charitable management. What can we expect?
It's about the Robertson lawsuit against Princeton during the 2000s. His parents, Bill Robertson's parents, made the largest gift to Princeton in its history to endow the graduate program at the Woodrow Wilson School. The lawsuit involved the contention that Princeton wasn't doing the job it should have with the money and was not honoring the donor's original intentions. This is an issue that first of all, it's in the front pages of almost every newspaper almost every day, but on top of that, it will continue to beleaguer organizations for generations if this issue isn't dealt with correctly.
What's the name of the book?
Well, the working title is Tiger by the Tail.
The Princeton Tigers.
The Princeton Tigers.
Brilliant. We have to leave it there, gentlemen. Thank you very much.
You're very welcome.
Thank you.
Closest to me is Doug White, adjunct faculty, Columbia University, and Greg Muth, private investor, also adjunct faculty for the Lions at Columbia University. Thank you again.
You're welcome.
Thank you.
Tony Martignetti, Nonprofit Radio coverage of Fundraising Day 2013. Thanks very much for being with us.